Okay, recording this video Monday 9th of June 2014. Hope you had a good weekend. It's actually a bank holiday here, a public holiday in Sydney, Australia. We're celebrating the Queen's birthday, and that is the Queen of England, believe it or not. So it's kind of a weird holiday here in Australia, but anyway, taking advantage of it. And got a little bit of time, so I wanted to dig into the Euro announcements out of the ECB last week. Mario Draghi had a very important press conference. The ECB made a number of announcements on Thursday, and it led to a huge amount of volatility in the euro on that day. Initially the euro sold off really hard, and then it bounced back all the way. It was about cent and a half move. It was a big move. And I just want to talk about that and just talk about what does it mean, what do the latest announcements for the ECB mean in terms of where the euro might go, and then we'll look at the charts. So I think, the big announcement out of the ECB was all around this negative interest rate, and I just have a feeling that a lot of people out there don't quite understand what the negative interest rate means. So I'm just going to go through that really quickly. Sorry to bore you if you kind of understand this stuff, and I hope I don't make any mistakes. This is a page taken from the ECB website here, and it shows you the interest rates over time as the ECB has kind of changed those. And this is the number to focus on here. This is the negative interest rate that they've kind of introduced. Negative 10 basis points here from the 11th of June onwards on deposit facilities. And then we've got the other two rates, which are the fixed rates, 15 basis points. They brought that one down from 25. And the marginal lending rate is at 40 basis points, again down from 75 basis points. The key thing here on the deposits is what they're trying to do is the ECB is sitting on excess reserves from all the banks around the eurozone system. They've got all these excess reserves that they want the banks to lend out. Similar to the TARP kind of fiasco that we had in the US with the financial crisis. The Fed goes to the government and said we need all this money for TARP funds and it'll be lent out to Main Street, and of course it didn't happen. All of that TARP funding, the billions, hundreds, $800+ billion of funding just sat in excess reserves in the Fed, and the Fed could do nothing to encourage the banks to actually lend those out to Main Street. Well, even though the banking system is somewhat kind of damaged still in the eurozone, because they've not written off a lot of the bad loans. So, for example, the Spanish banking system is sitting on billions and hundreds of billions of kind of bad loans on real estate lending there, because the real estate market has absolutely collapsed, commercial and residential, and has never bounced back. So they're just sitting on those kind of bad loans, and rather than a lot of the eurozone kind of banking system is damaged to some extent. They still have these excess reserves, though, that they've not taken as capital hits on their balance sheet, and they've chosen to just park with the ECB. What the ECB is trying to do is to charge them 10 basis points in order to get them off the balance sheet of the ECB, take those reserves out and lend them out to the broader economy. Now, that's one kind of aspect to it. Whether it'll work or not, there are various kind of scenarios kind of going forward, and the fullness of time will know the answer to this, what actually happens. But there have been 3 or 4 kind of suggested repercussions from doing this. The first one obviously is that the banks go out and say, right, I'll pull those excess reserves out. I feel as if my balance sheet's in good shape. I'm going to lend those monies out, and so there is actually kind of more lending going forward into kind of the consumer market and to the commercial market. So that's what the ECB is planning for. The second thing that might happen is that the banks might choose to say, well, okay, that's a 10 basis point charge on those reserves there. It's just the excess reserves, so it's not the reserves that they are kind of fiduciary bound to hold with the ECB as part of their funding mandate. This is just over and above what the minimum rates they have to, the minimum amounts of capital they have to hold with the ECB. So it's just on the excess, and they could say, well, why don't I just pass that back on to my customers? So the customers will take a hit of up to 10 basis points on deposits in their accounts. So that could be another kind of scenario going forward. The next one could be that they take those excess reserves and they say, right, it's time to kind of straighten up our balance sheet, and we could go through share buybacks and reduce, strengthen our kind of capital position. And then the alternative, the fourth alternative, is just keep it in cash and say, right, well, I won't have a book entry with the ECB, I'll just hold it in notes in my vaults. Could be pretty big in terms of number of notes, talking literally hundreds of billions of euros. But anyway, that's an alternative. So it's one of four kind of routes. It's as much as the ECB can do in order to encourage them to do that lending. That's one kind of side of things. So that's what's going on with this negative rates. You'll see it kind of plastered everywhere, but it doesn't mean that rates are going negative for everybody, and in fact what they're trying to do is just get those reserves moving into the system. The more interesting aspect, or there was another aspect to this whole thing that the ECB announced, and they've moved now to what's called TLTROs. We had LTROs the last couple of years, and now we've got a TLTRO here. This thing is quite interesting, and this is where they're trying to encourage again more lending into the eurozone system. And they talk about this as the transmission mechanism is being broken in the eurozone, and so they want the whole thing to be kind of improved. And the transition mechanism is basically where they're saying the ECB is pushing on a string. They can't get the lending in they can't get the banks to lend in the whole eurozone because all they have is various policy levers, and they can't instruct the banks directly to lend. But they've come up with this thing, this TLTRO thing, which is fairly big in terms of dollars. And what they want them to do is they're basically going to fund the banks at a very small rate. I think it's only 10 basis points here above those long-term rates. So I think it's at 25. That's given a total of 25 basis points funding cost, where they want them to lend money to the non-financial private sector. Here's the kind of the key bit of this: the non-financial private sector, excluding loans to households for house purchase, blah blah blah. So they want lending to credit cards and educational kind of loans, auto loans, and then they want business loans out there. So no, they're not supporting the housing market directly by putting more funds there, but they want the banks in the eurozone to lend out to these. It's kind of pretty desperate at times. The ECB they've not lost control. I mean, I think they've been fairly. I mean, I would have panicked, if I were in their shoes. But Mario Draghi et al. Do appear to have kind of kept their heads kind of straight through this whole crisis. But they cannot get the thing kind of going, the economy going in the eurozone, and they've got a deflation happening at the moment, and that's why the eurozone currency has been strengthening. Now, what about the balance sheets? Because this is what we've learned over the last couple of years is the relative size of the money printing, and the balance sheets is kind of key. We've got all of the gold bugs going out and saying, well, any money printing by the Fed is going to debase the US dollar because the more dollars we have out there, the value of those dollars go down. Well, and that's kind of the Peter Schiff and all the gold bugs type kind of story. And they're right, except they've taken it in context of just if there were just the US alone and no one anywhere else did anything about the amount of money they were printing. And what we've learnt in the last 2 or 3 years, it's the relative amount of money printing that's kind of key to determine what the currency is going to do. And so the US dollar has been strengthening during periods where we thought the dollar should be going down in value, and it's because of the relative printing that's happening in the different economies. So let me just show you. This is a very good piece of work. Global Economic Briefing, Central Bank balance sheets from Yardeni Research Inc. And I found this obviously online. This has got very recent numbers, but these are the two charts I want to show you. So first of all, this is the Fed balance sheet. I apologize, I'm just going to move this over so you can see this. This is in trillions of USD, so up to 4.4 trillion. And then here's the ECB balance sheet. Similar kind of metric in terms of trillions of US dollars, same kind of values kind of going on here. But what's important is how these have changed over these time periods, and we've got two things going on. First of all, the Fed, yes, were getting incredibly active during the financial crisis, and they were, printing money, quantitative easing, and so on from 08, 09, coming into mid 2011. During that same time period, the ECB were pretty much doing nothing. It wasn't until the euro crisis hit in 2011 that they actually had to get off their arse and do something. So the Feds were doing something during that time period, but the Europeans were doing nothing. But then we go through this period where the Feds are doing nothing up until mid 2012, and you can see then the ECB up until mid 2012, their balance sheet expanded hugely. Now this is the LTRO program where we had banks borrowing money in the eurozone against from the ECB in order to do a couple of things. First of all, they had to, at that time, a lot of the euro banks had problems issuing debt, and so rather than rolling over their debt and going to the market and paying outrageous rates on their debt, on their bonds, they could go to the ECB and get funding instead. Then they could also use that money at very low rates in order to buy government bonds, and they kind of stuck mainly with the country that they were kind of in. And that's why the balance sheet of the ECB went up so hugely. So remember, assets on the balance sheet of a bank are loans. So this is the loans by the ECB that they've made out to all of the banks in the eurozone system. And so that expansion was the LTRO program, which they used in order to raise debt themselves and kind of try and fix their balance sheets, and then go out and buy government bonds. And this is an example of what actually happened at that time. This is the Spanish government bonds, 10-year into mid-2012, and this is kind of height of the crisis of the eurozone, and this is sitting up at about 7% up there. And you can see during that time, so when those loans were going out with the LTRO program, they could buy bonds at 7.5%. The Spanish banking system could buy Spanish bonds yielding 7.5%. And the general public, you and I, well, me certainly, was kind of concerned that the whole thing was just going to spin apart. But the banks kind of kept their heads straight and said, well, we don't think it's going to spin apart. If it all does spin apart, we're lost anyway, so we might as well play the game and make the assumption that the system will survive, and we're being offered bonds at 7.5%, so we'll take them, we'll buy them. And they could get that money, it was 25 basis points or something from the ECB, and so they earned a huge spread on that, and that spread could be used to basically fix their balance sheets, kind of cash injection to the balance sheets of those euro banks. So during that time period where we had this huge difference in what was going on between the ECB and the Fed had kind of, their quantitative easing had stopped, and the ECB's kind of rocketed forward. So we had money printing going on in the eurozone, and we had relatively stagnant money printing in the US economy. So what actually happened? So I'm marking this as a weekly chart of the euro versus the USD. So this is kind of early 2011 into mid 2012, and this is the critical date here. So during that period where we had the eurozone effectively, money printing, quantitative easing, although the ECB is not allowed to do it directly, they did it through this LTRO program, lending the money to the banks who then went out and bought the bonds. We had the euro sink in value, so it went from 150 down to 120, so it was about a 20% decline in valuation versus the USD. But then subsequently the euro has strengthened, somewhat, back to 140 the other week it made it to. And what's going on there is, here's the ECB balance sheet here since mid-2012, where it's reduced dramatically, almost back down to what it was prior to the crisis. And this is all the LTROs being paid back to the ECB. So all of those loans that the eurozone banks were making, were borrowing money from the ECB, they paid all of that money back to the ECB, and so they've reduced the amount of cash in the system effectively. We're having deflation going on in the eurozone because the value of money is actually going up. So if we have inflation, the value of the currency goes down. If we have deflation, the value of the currency goes up. So the euro has been strengthening while we've kind of backed off on the money printing, and the LTRO loans have all been kind of paid back, or a great deal of them kind of paid back. And the question is, well, is the eurozone banking system fixed now because they've paid that money back, they don't need the money and so on? A lot of people would say no, the problems still kind of sit there. But in the meantime, what happened was the Fed started money printing, and this is QE to infinity, kind of going on until we had the taper kind of coming in kind of more recently, where it's kind of just backed off. And during that time period, that's when the Fed were money printing and the eurozone's balance sheet was being shrunk, and we had the euro increasing in value, so strengthening here. So we've had these two kind of moves. Now what the ECB is trying to do with these kind of programs is get the lending going and get the banks to borrow off the ECB, to use those funds to lend out into the broader euro economy and to reflate the ECB balance sheet. So what they're trying to do is to get to a situation where we kind of go into the euro breaks down again and we start going through a downtrend sequence. They're trying to pump up the economy with a weaker euro and also get kind of inflation going because they're dead scared of deflation. Now, just before moving to the charts, I'm just going to show you a couple of other things. This was the moves in the Spanish interest rates, the 10-year interest rates, with that peak in mid-2012. And so the rates have come way back down. They're under 3% at the moment. So, that game is no longer being played where you could buy your bonds at 7.5% with 25 basis points kind of costing and make the spread on that. But what is going on, and so this is a more representative picture of the whole eurozone. This is from Zero Hedge. Thank you. This weekend they published this, one of their articles. This is the European sovereign risk has gone from over 250 basis points down here to less than 50 basis points. The question is the eurozone kind of fixed? And there's a couple of things kind of suggest not. This is the macro surprise index kind of that's going on over the last several months, been weakening quite dramatically. We've also got, this is another chart, let me just shrink this up a little bit. This is the earnings revisions kind of leading up to the first quarter of 2014, and the earnings growth has been kind of steadily revised down and down and down. And then we've also got, I'm in the middle of Harry Dent's book at the moment, which is talking about the population aging in the eurozone, and he's saying 2014 is the peak for the German market when you look at population statistics and the spending wave, where we maximise our spending. I think it's at 47 or something like that, 47 years of age. So the peak in the size of the population move forward by 47 years kind of gives you a peak in the economy, and that happens to be 2014 for the Germans. And his argument is that there is that'll surprise a lot of the pundits, because we're relying in the eurozone for the German economy to kind of power ahead and bring everybody out of recession. And if actually they just hit a natural stumbling block, just like Japan did when their population kind of peaked, that'll be very difficult with a naturally declining economy in order to kind of save everything and get everything kind of fixed and right. So you're kind of going against the trend, if you like, if as the ECB you're kind of trying to persuade the euro banks to lend to the commercial sector and get things kind of going in the eurozone. And potentially there are a lot of headwinds with the aging economy and just natural problems that have not been fixed in Europe, particularly the sovereign bonds and the amount of debt in the system and the higher taxes and so on. That's just just pushing back and back and back on the European economies. So the question is, with these moves by the ECB, can you really encourage the banks to go out and lend? They have to have good prospects to lend to, and the counteracting force is that the European economy is really slowing and has all of these dead weights on them. We have aging populations, we have higher taxes, we have moribund political systems that are kind of don't have kind of clear direction and so on, and then we have problems with immigration. We have general kind of malaise in some countries, and then outright kind of dissent in others. And so can you actually encourage the banking system to lend and increase the balance sheet of the ECB? So that's the question kind of going forward. Will we actually drop through this kind of key trend line and the euro will kind of visibly weaken? Now, 3 or 4 weeks ago I did change my tune on the USD and the euro because we had a maxing out on the USD and the euro started to weaken, and my favorite European or currency in that zone, in that area, has been the British pound over the last 6 months. And I was saying, is the love affair over with the British pound, because it's going to weaken as the USD strengthens. So let's just go back to the charts and get a read, technical read on what's kind of going on. This usual kind of weekend setup. We're looking at the daily and the weekly charts using the better indicators, and then I look at the commitment of traders numbers weekly and monthly here as well. So first of all, this is what happened on the Thursday with Draghi's announcement, where we initially had a huge drop. We fell down to 135 in the euro and bounced all the way back up and a little bit more by the close of the day. And so The question is that the bottom? Is that one of these kind of blue professional spike bars where it just reverses from there and we kind of go the other way? You can see it's actually ended up being a blue professional spike bar on the weekly chart as well. I mean, we've run into this resistance on the weekly chart, pullback to end of trend, Rambo patterns up here at the highs. We had pullback to dirty end of trend here on the daily chart with that spike, and then a sell down here getting the move going. So this exhaustion selling volume here is the combination of these 4 or 5 kind of weekdays just selling this move down. This is getting the thing going. This exhaustion pattern here from this sell down move. We had a little bullish divergence where it kind of started to slow down, reverse and go the other way, and we've had this spike down. For me, the way I interpret that spike down is, first of all, to say when you have blue professional spike down bars like this, don't rush in. You got some time, because if this is a real bottom and we're going to reverse and go back to 140 and whatever, then we'll test it. We'll come back into this zone and we'll have an amateur down bar or a low volume down bar testing back into 36, 35, and then from there we'll get going. Or, so that's if this was a bottom and so on. So there's no need to rush in. Because there'll be a testing sequence after that where we'll come back into that zone and then kind of travel back up through the highs, and that will be a reversal if it does take place. I don't think that's what's going to happen. I think what we're going to do is we're going to have a little bit of strength up to 137, maybe 137.5, back into this zone where the professionals were really keen to sell it down. Remember, in not too many days, in 3 or 4 weeks, we've gone from 140 to 135. That's a fairly big move in the euro over a short period of time. So the smart money was probably just taking profits and saying, look, I got short at 139, I could get out at 135, 135 and a half. I'm happy enough with that for a 2-week move. So that could have been just profit taking. If we get a bounce back, a weak bounce back into the 138 type level, 137.5 highs, high 137s into here, and then it starts to sell down, then look for this continuation of a downtrend, and we're going to break the lows of that blue professional bar. It was such a big spiking bar. I think we're just going to play up a little bit from there, because psychologically it's kind of shaken people out potentially, and we'll play back in, and then I think it's going to kind of resume its downtrend. Remember, we've broken support on the daily chart, we've broken support on the weekly chart. So we've got downtrends in place, but all the downtrends, these trends never kind of move in straight lines. There's going to be kind of toing and froing. And I just think from that exhaustion volume, blue professional spiking down bar, we're just going to play up a little bit and then continue down. So if we get the reverse and we kind of play in here and low volume test down here, amateur down bar into 135.5 or something like that, and maybe it's going to be a stronger bounce back, but for the time being I'm guessing we're going to bounce weekly back to here and then continue on the way down. So it was a little bit of a scary move. Initially it was nice to say, okay, called the euro going short, and it was kind of going nicely in my favor, but this thing bounced back quite strongly. Let's look at commitment of traders as well, because don't forget, I look at these on the weekly and the monthly chart for kind of confirmation, and I take the raw numbers, I flip them upside down, because that's the way they move more neatly, with kind of price, along with price, and then I look for bullish and bearish divergence signals. And this low was caught with nice bullish divergence patterns coming in on the weekly and the monthly charts, and the high was caught beautifully by bearish divergence patterns on both the weekly and the monthly. And this week's activity, we've had a follow through with the numbers kind of falling in line with a continuation on the way down. So that's all kind of good stuff that kind of supports this longer term downtrend, but we're just going to have to sit through a little bit of volatility until that Thursday's big activity kind of gets kind of played out. The flip side is the dollar index. So the largest component of the dollar index is the euro, and the commitment of traders numbers here we can see are almost the exact reverse. So we've got bullish divergence patterns on the monthly charts and on the weekly charts kind of come in here. The numbers aren't as strong, kind of a move in the other way, but don't forget we've got a bunch of other currencies in here in the dollar index. Aussie dollar's looking quite strong at the moment. The pound's still got some legs. It's got to play out a topping out move before a real downtrend kind of sets in. So we've got some other things kind of going on in the dollar index, but it is positive on commitment of traders for the dollar index continuing to strengthen. And you look at the chart is kind of the reverse of the euro chart, where we had this spike up above 81s and then we've kind of come down. I think, again, because pullback to end of trend with exhaustion patterns, bullish divergence, we had this U-turn with the blue professional bars buying the dip and then chasing it all the way back up. We kind of got going to the upside. We just maybe have traveled a little bit too far. So there's that kind of spiking blue professional bar. We might just settle back down a little bit and then kind of find that support level from which we can kind of rally back. Any rally back above 81, or on the euro kind of under 135.5, something like that, people will say, whoops, yep, it was going down, it was heading down, and we this was just a blip that we had to kind of sit through because the downtrend is in place. So there we go. That's a little bit of what the ECB is up to, and it hasn't changed my tune on where I think the euro's kind of going or the dollar index is going. I just think we're going to have to sit through some volatility until this day and what happened kind of gets played out. Anyway, I hope your trading's going well.